everyone. Welcome to the webinar Trading Psychology Discipline with Thomas. I'm Thomas. I will be hosting the webinar today. I hope you will enjoy. We will be discussing today the webinar regarding psychology of trading. So first of all, me, Thomas, I've been working in AvaTrade for the last few years, and while working here, I got the chance to talk with many clients and traders that have been trading for quite some time, and I will be sharing with you today from the experience that I have as an account manager, senior account manager in AvaTrade, and obviously the main challenges that traders are having when trading. Some of it comes to knowledge how to operate the platform, calculation, profit and loss, and some of it regarding the psychology of trading itself, how to learn to have a more disciplined trading journey. So for risk disclosure, any capital markets and trading information disclosed in this webinar is provided for informative purposes only and should not be constructed or applied as investment advice, recommendation or suggestion. CFDs are a complex trading instrument and come with a high risk of losing capital rapidly due to 57% of retail investor accounts lose money when trading CFD with the provider. You should consider whether you understand how CFD work and whether you can afford to take the high risk of losing capital. So first of all, in terms of the webinar agenda, last webinar we discussed really about psychology, about different trading habits, about trading journal. The webinar that will be managed by me, we are basically covering every webinar, different section, different part. So I advise you to always go through the YouTube channel of AvaTrade, and you can visit the previous webinar to make sure you are familiar with the subject that we have discussed previously. And so today we will go back to the WebTrader. This is the same subject we went through the first webinar, where we will be discussing how to calculate profit, losses, and maybe we will extend it a bit further. First of all, I will show you the WebTrader. First of all, this is the page where you log in. Once you log in, you'll be able to see your accounts and also the demo account below. Once you click here on web trading, it will direct you to the relevant platform. For the sake of the example today, I advise you to have a demo account. So while we are on the webinar, you can open and close positions on a demo to practice some of the things that we will be talking about. We will start talking with the basics and then we will move forward from there. So essentially here is the main page of the WebTrader. Once you log in, you'll be able to see this page. On the left top, you see you have the three blue lines over here. Once you click on that, you can see your account number. This account number will be used also for the MetaTrader platform, that you can log in to the MetaTrader terminal itself. Under my account, once you click accounts, here you will be able again to see your account number. Also, you'll be able to see an option to add an additional account. Over here, you see on the right top, you have add an account. If you currently do not have a demo, you can just set up a demo, and you can also set up another real account. So you will be able to have a few different accounts if you want to have one MetaTrader 4, one MetaTrader 5. Basically, the difference between a MetaTrader 4 and 5 is that MT5 have a larger selection on stocks that you can trade on. And also there are nano lots on MetaTrader 5. I will show you what is nano lot. It's just that you can trade on a smaller position size on some of the trading instruments. So we finished here with the My Account section. And once you click here on the left top, it will direct you to the trading platform where you click trade. And here you can select the trading instrument that you have in mind. You can select, you can type the first 3 letters, and then it will find whatever you want. So BTC stands for Bitcoin, and it's giving you all the pairs relevant to that. As you see, BTC Euro, BTC USD, and here you can also search for a specific stock you have in mind, or if you have a specific instrument that you are inquiring about, also you can look it up here. So this is just search bar. Below we have favorites. Favorites, you can use that in order to add instruments on your favorite. And then below it is divided by different sections. Hot, most rising, most falling, most buying, most selling, and the categories of each one of the instruments. Forex is equivalent to currencies, indices, crypto, commodity, stocks, ETF, bonds. So you can get ideas on what you want to trade on over here as well. And now we will continue with the presentation. And I will keep showing you the other platform, how it looks like on the website itself. So first of all, as you can see, when you log into the account, you have the trading account overview panel on the top. This is something that even experienced traders are not always necessarily familiar with the way everything works. It also has something to do with the psychology of trading, because as a trader, you also need to know how to calculate your level of risk, calculate your level of profit. Many traders are getting confused between the balance and the equity, which is very important to know, to differentiate between the different values. Okay, so balance basically represent your closed positions only. So when you close the position, the balance will go up or will go down, depends on the position, profit or loss. But the equity will represent the real value of your account, including your open positions. So the balance represent the closed positions, the equity will represent also your open positions. So if you close all of your open positions, you will be left with the equity. Then the free margin represent the amount of money you have available to place your new positions. When you will open a trade, it will tell you how much free margin is required to open a trade. And then we have the next one is equivalent to used margin. I will show you now how it works. Used margin represents how much money is required to place the order. So the free margin should be higher than the used margin. Then we have the margin level in percentage. This is also very important to know because if your margin level drops below a certain percentage, the position will be closed automatically. If you are based in EU, it will be closed below 50%. And if you are based outside of EU, it will close below 10% for the global clients we have under the BVI regulation. So we have the 10%, 50%. And then we have a margin increase when you close a position. The margin increases back to the account unless it's a hedge position. What is hedging? Hedging is that you open a position on the same instrument, one position buy, one position sell, and you use the same lot size for the position. Soon I'm going to share with you examples how it looks like. And then we have gold. So I would show you so you can see visibly exactly how it looks like. For instance, if we choose gold, you see once you select the lot size, the system will tell you what is the margin impact, which is equivalent to the required margin to open the position. Okay. Since I have right now a used margin of 290, I have free margin available of 9,500 and something. Okay, so once I change the lot size represent the exposure for the position. If I open a trade with a bigger lot size, it means the profit or loss per each point the market moves will be higher, and if I choose a smaller lot size, the profit and loss per each market movement will be smaller. So for position size, the bigger position size will essentially require more money and more margin to open a trade. If you are again based in EU, so your leverage will be lower substantially due to the regulation in EU. So in such case, you will need more margin to place an order. We call it the leverage. Okay, the leverage represents the amount of money that is required to open a trade. So if the leverage is higher, it means you need less margin to open a position. If the leverage will be lower, so you will need more margin to open the trade. Now we can continue. We talk about the margin impact. The spread is the difference between the buy and the sell price. The spreads in AVA are floating spreads. It means that the spreads can widen and then the spread will shrink back to the original value. What else we have? So the leverage also you can see per instrument, the buy and the sell price. Also you have instrument details. Once you click on that, you can see more data on the position itself under instrument details, currency, lot size, currency. Basically, it's giving you the actual base currency traded on the position. Some traders have a preference that the account currency will match the currency that they are trading on. So you will avoid having a conversion rate, if that makes sense. I will clarify again. What I'm saying here, you can see the currency of the instrument that you are trading with, and some traders have a preference that the account currency will match the currency they are trading with. So they will not have a conversion fee, like a conversion rate every time. Okay, so if you want me to give you an example, if I will change the account currency from dollar to euro, every time the price of gold will move, it will be converted from US dollar to euro because of that. And we have here trading hours, lot size, that's for the position, the market opening hours, the spread, the leverage, the margin percentage, minimum trade size. This is something important that you should be familiar. This is the swap rates, the overnight interest, and you can see this one for buy position is negative, for sell position it's positive interest. So if you hold a position on sell, you get a certain percentage, you get money for placing that order and holding it. So if you essentially hold a sell position on gold, you see you have a positive return on that. But if if you a sell position, you get positive. A buy position, you get a negative. You need to pay to hold the position. How does it work when you open a position? So every day, essentially, after a certain time, normally around 10 GMT, then you will have the overnight interest calculation. We need to dedicate some more time for that. Maybe in our next webinar, I will share with you the exact calculation and the days on each instrument. Some instrument, the rollover is higher on some dates. So if you are planning to hold a position for longer time, it is important that you get a little bit more familiar with the concept of the overnight interest. Okay. By the way, if you have questions, you can share. Okay, you can just let me know what is the question, and then I will answer the question that you have. Okay. Then we have overnight type, percentage of the open price, measurement unit is Troy Oz, day of change, week change, monthly change, 3 month, 6 month, 1 year. And here you also see you have the graph, the graph of gold. Okay. You have here the candlestick chart that you choose. You can choose the one that you want to use. Each candle represent the time that you set. So if I change it to 1 minute, each candle represent 1 minute. If you click here and then you click on the crosshair, it's going to give you the price at the time that you select. Okay, as you can see, if you change the time to 5 minutes and 15 minutes and 30 minutes, the higher you go, you can see more history. What do I mean by more history? I mean that you go back in time on a bigger scale. You see here, you go to the 1st of December. When you change it to the 2-hour, you go to the 21 of November. You change it to the 4-hour candle. You go to the 3rd of November. You change it to the daily. Here you go to June 25. The reason for you, why would you like to change the candle, so you will be able to decide what kind of time frame you want to look at. So here we are looking at about 6 month time frame from June. And you can also analyze the graph as you want. Okay, you can see here on the 15th of June, the value went down up to the 30th of June, and then corrected itself upwards, downwards, upwards again, and you can see the price on the 23rd of July is equivalent to approximately the same price on the 16th of June. So here you see it broke a certain point, and after August, it broke the point dramatically. So you can see here June, July, and August. It's a big break of, if you want, you can also use different tools. And set it the way you want. For example, over here you put it, and you can see that it broke 1, 2, and then it went up. So that's just an example. Not sure if you have a preference to do some of the analysis on our WebTrader, or you have a preference to do the analysis on the MetaTrader. Basically, you can do both. You can have the MetaTrader installed on your laptop or on your computer, and make sure that you know how to log in, so you have that always available as well. Or on the phone, you can download our app, the AvaTrade app, and make sure that you're also logged in through the phone, and also the MetaTrader app that you can download. So MetaTrader you have on the computer, you have it on the phone, and you have our app, the AvaTrade app. So I just discussed a little bit about the candlestick. Then you can go to weekly and monthly as well. We're not going to talk too much today about charting. But this is just a little bit, and now we can continue with the same topic we were discussing on our first webinar, and a little bit more about psychology of trading. When it comes to trading, as a trader, you are responsible of the calculations of your profit, the calculation of your losses, and you should know in advance approximately how much money you are planning to risk on the position in terms of your risk appetite. Risk appetite is that you decide how much you want to risk from your total account. If you want to have 1%, 10%, or if you want to have full exposure, which means that you are putting in risk the whole account. And I will share with you shortly how to calculate approximate profits and losses when you are trading using our PIP calculator. But now I want to share with you a product that's called AVAProtect. AVAProtect, this is a product that is allowing you to have a protection on your capital for a certain period of time according to the duration that you set for the position. What does it mean, protection? It means that if you have negative floating between a certain period of time, and you decided to pay for the protection. You see here, it says the price of the protection, okay? And the price will go up or down, depends on your position size. So if you trade on a bigger position size, for example, one lot, the protection will be 2,000 for one day. For 10 lot, will be 20,000. For 100 lot, will be 200,000, due to the fact that you are trading on a bigger one. But if you trade smaller, so for 0.01, you see is equivalent to $20. If you change the duration to 2 days, you see it will be more expensive. So how does this a product works? It works in a way that you need to have money to pay for the protection. You need to have margin to open the position, and if within that time frame of the duration you have losses on this position, once the duration expires, the negative floating will be reimbursed automatically. If you do not have negative floating, so it means your position is either zero profit and loss or either in profit, and in that case the position will keep going and you will not get any reimbursement because you did not have a loss. I will share with you a little bit more over here so you can see it more visibly. We go through the protection. So here I open a few screens, giving you a few different examples when I trade on a one lot for 1 hour, one lot for 2 days, 0.01 lot for 1 hour, 0.01 lot for 2 days. Just giving you different examples so you can see the difference here in the pricing. As you can see, for a bigger position, also the price is higher because of the bigger level of risk that you are taking. So here I give some information. What is required to place an order with AVAProtect is a free margin, and then obviously the cost of the protection itself. When will the charges appear on the account for the protection? It will be immediate when you open the position. How your loss will be reimbursed under two conditions: either if you close the position during the protection, or either if you have a negative floating by the time the protection expires. How do you make profit on AvaProtect? You need to make more money than the price of the protection when you close the position. What happens if position continues after the protection? So in that case, you will no longer be protected because the duration expired. So in that case, you can close the trade, open a new trade with the protection, or just let the position keep going without the protection. Here we shared a few examples on how the protection will give you the reimbursement. So for instance, if you have a position with 0.01 lot on gold with a 2-day protection, and you see the price depends, the price is moving, but for example, if the price is 39.33 and you have a negative floating of $100 by the time the duration expires, what happens? The $100 will be reimbursed automatically. So it means you actually lost the price of the protection. You lost here $40. And effectively you saved $60 due to the fact that you were supposed to have a bigger loss. Now, if you give an example with a larger position, for one lot on gold, 2-day protection. Let's say the cost is 3,933. You see a multiplier of 100. If your negative floating by the time of the duration expires is 10,000, you get 10,000 reimbursed, saving $6,000. So you lose 3,933, which is the protection cost that you pay upfront. Also, this is something to do with psychology because you are actually knowing in advance how much you are risking for that period of time. A profitable scenario will be, it's not a profit that you will be making, but a profit of the position itself. As you can see, protection cost is 39.33. If you end up with $10 profit on the trade, it means you won't get reimbursed, and also it means that you lost $29.33 due to the fact that you paid 39.33 and you only made a profit of $10. A bigger position would be, let's say, protection cost was 3,933. You end up with a profit of $2,000. So also you won't get reimbursed because you made profit, and this position is also losing because the protection cost was higher than the profit you made. So here, if I wanted to make a profit, I needed to make more than 3,933, and here I need to make more than 39.33, and here I need to make more than 3,933, and here I need to make more than 39.33. Again, if you have a question regarding, you can let me know. Okay, so now we jump to another subject regarding orders. So under more options, we have execute when price hits. This is equivalent to a pending order. You need to select what price you want the position to be triggered automatically. And based on this price, the system will open the position once the value reach the value that you have set. So for example, you decide to open a buy position on gold when the price of gold reach 4,100. Lot size you decide, and then once you execute buy, and you see on orders, your pending order have been executed. What it has to do with psychology of trading, in our previous webinar, we were discussing about different behavior and patterns that lead to more disciplined way of trading. And also here, when it comes to a pending order, this is a behavior that allows you to have a control, a better control channel on your trading, because in advance you set the order, you execute it before, which basically means I open this order and now I don't need to do anything for the order to be open. So I don't need to think, should I open or should I not open, because the system will open it. So I hope this one is clear, and this one is important, and this is very, very common among our traders. Many traders are opening positions with pending orders, and Also, you can click here to edit the order. And on the edit, you can change the price. You can add expiration. Expiration means that when the value doesn't reach the value that you set up to a certain date, so you want the position to be canceled automatically. Over here, cancel on date. Now I will be sharing with you the take profit, the stop loss. So we go out of this page. If I want to close the order, I click here on the X, cancel order. I go back here. And now I will be sharing with you the take profit and the stop loss calculator. So what is the take profit and the stop loss order? So take profit is a request from the system to close the position when the value reaches the value that you set on your take profit. You can set here the price on the left, okay? And it's giving you also a percentage, for example, 5,000, okay? Or 4,500, or 4,300, whatever price you want to put. And the system is going to calculate what is the possible profit you're going to have when the price of gold reaches the price you set. So if the price of gold reach 4,300, the profit that you will be making will be approximately 1,200. And this is equivalent to the lot size that we have selected 0.2 lots. If I change this to 0.02, as you can see, it reduces the possible profit by 10 to 120. If I change it back to 0.02, so it jumps again to 1,200. If I change it to 0.9, which is a multiplier of 90 from the minimum, then the possible profit jumps to 5.2 thousand. If I, for example, I want to take a bigger level of risk, I want to trade with 9 lots. For that case, my profit will be 53,000 approximately. You see, it's moving very, very quickly at these kind of levels. And once the price of gold reach 4,300, I will be making $52,000. And if I will change this one to 90 lot, so when the price of gold reaches 4,300, my profit will be $500,000. And for the biggest position size, which is about 90 lot or even a little bit more, depends on the exposure limit on gold, you see, I need to have about 190,000. So this is just, I'm showing you the minimum is 0.01 and the maximum is around 100, which requires way more capital. So this is a take profit order. You can set it when you want the system to execute closure when the price hits the price of your take profit. Stop loss also, you can change the price. For example, 4,300, my possible loss will be about 60. If I change that again to 0.1, I'm going to have a multiplier by 10. That's about $600 loss. And I change it again, multiplier of 100. So the loss will be about 6,100. And so on and so forth. 10 lots, my loss will be 60,000, 161, moving. I change it to 100 lot, my loss will be 600,000. So I'm just sharing with you the difference between obviously smaller position size, a bigger position size, so you can understand. And when it comes to stop loss, you are asking the system to close the position when the price reaches the price that you set. However, in AvaTrade, we do not provide the stop loss guarantee, which basically means that if you set the stop loss, the system will try to execute closure at the price of your stop loss, but not always it is possible for the system to close it exactly at the price you set. So sometimes you see it will close at the next available price, which is standard. It depends on the market value. So in that case, if you want to put stop loss, you can put it. If you don't want to put stop loss, you prefer to close it by yourself, you can also do it. Just take into account that the guarantee for the stop loss is not something that we offer. We don't have that guarantee. So if you want to have a guarantee, maybe you can use AVAProtect. And AVAProtect is available on currencies, gold and silver. If you have any questions, I see no one is asking questions. You can feel free to share. Okay, I see no questions yet. Okay, so we covered the take profit, we covered the stop loss, PIP calculator, profit calculator, margin calculator, how much money I need to open position. And to check, we covered lot size, we covered margin impact, we covered hedging, we covered, but I didn't show you. So when you the way it works is that some traders decide that they want to use a strategy called hedging. What is hedging is that when you open a position on the same instrument and the same lot size and different direction. So for example, if I open a trade on gold 0.01 lot on buy, you see the margin impact is $21. Let's say I open this position. Once I execute the order on buy, okay, if I want to have a hedge position, I open the same position, 0.01 lot on sell. And basically it means, you can see here, I didn't close the two bars below, so I didn't execute it. Now I do it again. Now I want to open a sell position to do hedge. I go to the same lot size, 0.01 lot. As you can see, the margin impact is 0, which means you don't need to have any margin to place the order. The only requirement for an hedging to hedge position is you need to have above 100% on your margin level in order to do hedge. So now when I click on positions, I can see my open positions. You see here, I have my two open trades, one buy, one sell, the same size. And then I can click here to close that position if I want. Also very important, the history. You can click here, all history, or you can change it according to whatever you want to look. And then you can see when you open the trade, what did you trade on, your profit and loss, the position size, the amount, the open price, the closed price. And also you can see specification, if it was profitable or not. Also here you have the position ID. If you have any issue about the position, you can take the position ID and then you use it on your ticket to customer support. Or if you have an account manager, that I do advise people to use the services of account manager, because what we are doing today is also something that we are doing with our clients, where you request a call from your account manager. Normally we do have different types of accounts. Above $1,000 normally you're eligible for account manager, and then you can ask them to call you, or you can email them with different questions. For example, I get questions like, "Hi Thomas, I want to open a trade on whatever, let's say gold. I want to hold a position for 1 year. I want to open a position with one lot. How much overnight interest I'm going to pay?" So obviously you can ask your account manager anything. Also you can schedule a call and they can guide you through the platform, technical, fundamental. And also we will be continuing, of course, the webinars weekly, and on the next webinar you can come up with some questions. And as I mentioned, the webinars we are doing are basically a build-up. So the first webinar we discussed pretty much the same subject. The second webinar we discussed more of psychology. The third and the fourth webinar will probably go back to a little bit more psychology. I shared with you in our last webinar what kind of things drive the trader to trade or over trading, and many things about the psychology of trading that is important. This subject basically means that as a trader there are some factors that causing you to open a position or to close a position, and it is very important for you as a trader to know how to set in advance a certain plan, and then you need to follow a certain plan that you set in advance. So if you manage to do that, the psychology of trading can improve, because there are two different factors. You have the factor of analyzing and having a strategy. For example, I want to trade on a UD card, okay? I want to open the position when the price reached this point, or I want to use a certain indicator, and I want to base my analysis on a certain indicator, let's say Bollinger Bands or MACD or stochastic, and then you have a strategy. So the strategy is one side, and also the psychology is more the execution of the strategy. So last time we spoke about setting up a trading journal that will allow you to keep a record of the strategy, and every position you open, you record. When did I open it? Why did I open it? Did I follow the strategy? What strategy did I follow? And this is very important because you need to have a certain discipline when trading to avoid the increased odds of losing capital. So now we'll go back to the presentation just to check that we covered all the subjects. AVAProtect we covered. Pending orders we covered. Take profit. And it looks like these are the main subjects we discussed in the webinar today. Basically, it was regarding execution on the WebTrader, opening positions, closing positions, and here we spoke a little bit about that funnel. Here you see you have the margin level, which is also very important, because if you want to hold a position and your margin level is below a certain threshold that you choose as a trader. Some of the traders, they like to have very, very tight margin level. Okay, tight means 100%, because 100%, you cannot open your trades with 100%, because it means your margin, your free margin is zero. So how does it work? Free margin is 9.5 thousand. Let's say I want to use all my free margin. How do I do that? I choose a trade that is equivalent to my free margin, which is about 57.5 maybe, for, you see, free. And I see here the required margin is quite close to the free margin. When I open the trade, what will happen? Okay, I got my free margin into minus because of the spreads required to open that position. It means that my margin level now drops below 100%. If this reach below 50% or 10%, depends on your account jurisdiction, the position will close. So some people like to keep this number above. About 100%, 200%, 1000%. Here I gave you an example where I use the full exposure of my account, which means I'm more likely to get into a margin call because I use a big position. When I close the position, the margin will go back to the free margin. And I will give you now the example that I have given you before, just with a more conservative number. Let's say 10 is more conservative than what we had before. Just to show you, right now the margin level is 2,700%, and now the margin level is 420%. Okay, so it's 4 times more margin level than what we had before. Okay, so that's regarding the margin level, which is also something important to know. I hope everyone enjoyed the webinar today. I will be hosting webinars weekly. I suggest that you visit the previous webinars so you can learn as you go and get more familiar with the different things we discussed. Next time we will discuss more things. Maybe we'll discuss the MetaTrader. And that's all, everybody. So have a very profitable and fruitful trading journey, and all the best. This is the webinar for today. Bye bye, everyone.